Welcome back to our channel. This week we tackle inventory because it is one of the most misunderstood aspects of a business transfer. If you're selling a business that carries inventory, you have to understand how to handle that inventory when you're structuring the deal. Get it wrong, and you could be out thousands of dollars. You may even kill the deal. In this video, which pertains to business owners, business buyers, and business brokers, I want to share a couple of stories from our files that perfectly illustrate this issue. The first one involves a client of ours who had been operating a hardware store for decades. It was a very solid business, $2.5 million roughly in annual sales. It was located in a resort area, and its revenue stream reflected that fact. Steady, year-round business from the locals, and handsome spikes in the high season. So here's the problem. We know that any buyer of any asset-heavy business is going to be suspect of any inventory estimates provided by a seller. This is just human nature. This is particularly true when we're dealing with a retail or even a wholesale business in which the inventory changes pretty much every day, if not every hour. So here's how we handle this. When we value and market a business, we ask our client to estimate the average inventory on hand on any given day in a 12-month period. And we include that amount in the asking price. For example, we might say to a buyer, the asking price is $1.2 million, which includes inventory of $250,000. Now, that statement implicitly values the business's discretionary earnings at $950,000. And just before closing, everybody will understand that a physical inventory will be taken by a third-party contractor. This protects both the buyer and the seller, and it keeps the deal fair. So now, why is this important? Well, there's a couple of reasons. This approach prevents the seller from padding their inventory numbers because everyone, including the seller, knows that a physical count will be taken at closing. Equally important, it also prevents the sellers from selling down the inventory, selling off but not replacing the inventory during the pre-closing period, which would then result in the buyer having to replenish that missing inventory after the sale, effectively increasing the price they paid for the business. But beyond fairness, how you treat inventory has tax implications for both parties. The way you allocate value among goodwill, inventory, any real estate that's involved affects the tax liability that both parties are going to eventually face. Now, here's another example. We're currently representing a wholesaler of water sports products. And during the busy season, inventory for their business can be as much as $500,000. But on the off-season, on the other hand, it could be as low as $75,000. According to our client, over the course of a year, on a daily average inventory level is roughly $275,000, a number our client knows is going to be adjusted when the closing occurs, based on what's actually in the warehouse on that date. So, we market the business at a price that includes an estimate of $250,000 in inventory, our client's typical average, and we adjust at closing to reflect the inventory that actually transfers with the sale. In this case, if the sale happens in July, the inventory might be $450,000, and the sale price would be adjusted up by $200,000. Conversely, if the sale happens in January, the inventory could be as little as $75,000, and therefore the price would be adjusted down by $175,000. Using this approach means no one's overpaying and no one's underselling just because of timing. So here's the bottom line. If you're selling a business with inventory, whether it's retail, wholesale, food service, or distribution or anything else, make sure of three things. One, the inventory value is realistic and verifiable. Two, a third-party independent contractor, an inventory specialist, is hired to do the inventory count at closing. And three, you're working with a professional business broker who understands how to structure the deal. When handled correctly, inventory is never a problem. When it's handled poorly, it could kill the deal in a heartbeat. So if you found this helpful, check out our 6-part series, How Much Is My Business Worth?, for more insight on how to value and price your business for sale. Links to that series and to other resources are in the description box below. And before you go, hit the like button. And don't forget to subscribe so you don't miss our future videos. A new one is posted every week. And our next one, incidentally, is a discussion on how to handle cash when valuing a business that has cash revenue. So post a comment. Let me know what your business is, and if you're considering selling, if you have any questions, and I'll try and answer every one that comes in. In the meantime, I hope that you keep well, and I will see you in the next video.